Thank you everyone for joining this Planning and Saving for the Future event, the first in a series by the McGill Young Alumni to help you sharpen your financial literacy skills. My name is Catherine Bertels, and I'm a 2016 science grad, and I'm on the Young Alumni Board. Our association aims to connect and support McGill students and graduates of the last decade, as well as building a diverse and global network of McGillians engaging in personal and professional development. With this first kickoff event of 2021, our goal is to equip you with the fundamental tools to save and plan so you can achieve your financial goals, just in time for tax season. For today's event, our speakers will each present for about 15 minutes. Following that, we will have a Q&A period to answer audience questions. Kindly submit your questions for the speakers at any point during the event. Now, I am pleased to introduce our two speakers. Today, we have with us fellow McGillians, Travis Chalmers, a senior legal counsel tax at Simplex Legal, where he advises on all areas of income tax, including tax planning for growing businesses and their families. Prior to the role, Travis was a director of Canadian tax at PSB Boisjoli in Montreal. Travis graduated with a BCL/LLB from McGill University Faculty of Law. And Jeffrey Wu, the president of How Wu Financial Solutions, Inc., a financial advising firm located in Montreal under the banner of Sun Life Financial. Jeffrey and his team advise on individuals, families, and business owners on their insurance, wealth, and group benefits and pension planning, and help them achieve their unique financial goals. Jeffrey graduated from McGill University with BA double majored in industrial relations and psychology. Now I'll turn things over to Jeffrey.
Thank you so much, Catherine, for your introduction. I'm super excited to be here tonight with you on a topic I'm very passionate about, on financial literacy. So I'm excited about this series because I personally believe that equipping yourself with foundational financial knowledge is essential for living a fulfilling life. And as COVID hit last year, I'm sure a lot of you must feel burned, and this panel and also the future events will bring together experts to give you some guidance on different topics. Since I'm the first presentation to kick off the series, my presentation will be very at a high level, talking about what is a financial plan, why do you need a financial plan, and also with a focus on some details regarding to registered investment accounts, specifically RRSP, TFSA, and RRSP. So I'm going to start with a number. This number seems very random, and it is very random. So I usually engage with the audience, but since I cannot see you guys here, I'm going to give you a hint. It is something to do with a couple in their retirement. And the answer is, it is the average number of meals that a couple will eat in their retirement. So let's do some simple math. Imagine a couple, they retire at age 25, and let's say they live a life to age 90, 2 people, 3 meals a day, and 365 days a year, which comes up to the number. And let's do some very conservative budgeting. Let's say per meal is cost $10, assuming you don't go to a restaurant, you don't do anything fancy. You do need like over $500,000 just for eating after retirement. This is just to illustrate that it is like, for any financial goals, it's very important for you to plan ahead, and it doesn't come overnight, and you do need to have a plan to reach whatever goals you have. To start, you need to envision your future. So each one of you must have your unique financial goals, and this is like the first meeting when I have with my clients. I usually just force them to envision a future in 2 years, 5 years, like 10 years, what's gonna happen to them and what do they wanna achieve. You may want to save up for education, for graduate school. You may wanna go for a vacation after COVID. You may want to get married in 2-3 years and you want a big wedding. You may have debts. You want to pay them off as soon as possible. You may want to buy your first home, or maybe you have done all of them and you want to just save for retirement. Whatever your goal is extremely important to make it specific, including dollar amounts and time frames. For example, if you want to make a down payment, let's say in 5 years, and you want to pay 20% of the property's value. Let's assume the property is $500,000. Then you need to, you know that in 5 years you need to save like 100,000 just to pay for the down payment. Or if you're splitting with a spouse or partner, then it's 50,000, and then you can have a plan to reach there. Once you have an idea of how much you need, the step 2 is very simple. It's just to start to save as early as possible. I put here some 3 scenarios for you just to understand the importance of starting to save as early as you can and the time value of money. So there are 3 people here, like Susan, Bill, and Chris. Susan invests $5,000 annually between age 25 and 35. And in total, she invested $50,000. And Bill invested the same amount every year. The only difference is that he started to invest at age 35, and he stopped investing at age 65. So basically, he invested 3 times what Susan invested. And for Chris, like, he is the most disciplined one, and he invested $5,000 per year for 40 years, and in total he invested $200,000. If you're a visual learner, like I put a graph here, so y-axis is the amount of money you have in your savings account, and axis is the number of years. And you can clearly see that even though Susan, who invested 3 times, only 1/3 of Bill invested, but started 10 years early, her investment account at age 65 is actually bigger than Bill's. And we're assuming a 7% on average return over all these years. And for Chris, like the most disciplined one, even though he only he invested only 50,000 more than Bill, his investment account is like over 600,000 more than than Bill's account. So this is just to illustrate the importance of compounding and the time value of money. So even though you set up like automatic savings for $25 a week, like maybe like $200 per paycheck, all these small contributions, they pay off in the long term. Now, like once you have these goals in mind and you understand the importance of savings early, basically you need to have a plan to turn these goals into reality. I won't go, so this is like this process is called a financial planning process. I won't go into details today because the demography today are relatively young, and we will focus most on the cash flow planning and a little bit on the investment planning side. Like Travis will talk about tax planning. There will be a event in the series that talk about insurance. And for retirement and estate planning, is if you're graduating within 10 years, maybe it's not the most priority, but like moving forward, it's always important to remember that to have a will, to have a power of attorney, to have a protection mandate, and to make sure that your beneficiaries and your whoever will take over your wealth, plan them accordingly. But today, like I will mostly talk about the first 2 aspects. Okay, so I will give you a relatively detailed explain like the overview for the 3 kinds of registered accounts. The first one is RRSP, Registered Retirement Savings Plan. The second one is tax-free savings account. And the third one, if time allows, I can talk a little bit about RRSP, but many of you may not have children. So like if you have any questions regarding to it, and if I didn't have time to go through it, you can always reach out to me after. The reason I'm talking about registered account is because at your life stage, the beginning of your career, it's very, like usually registered accounts are enough for your savings needs, unless like you do have a lot of investable assets. Most likely like RRSP and TFSA are enough for your needs. So let's start with RRSP. So it's a monopoly game, but I'm playing by myself. But for illustrated purpose, I think it's good for you to understand, good for you for explanation. So the premise of putting in money into RRSP is that you have taxable income. And the goal here, basically people put into RRSP for two main reasons. The first one is for tax deductibility, meaning the amount that you put into the account can be deducted from your taxable income. Let's say your annual your taxable income is 60,000, and you put in 5,000 into RRSP. It's basically your taxable income will be reduced to 55,000. And the second reason people do that is because you defer the taxes, also on a sense of your investment income. You won't be taxed on any distribution or any capital gains that arise from the account. So it's a good tool for you to save for the long term. Travis later will talk about the difference between employment income and self-employed, so I won't go into that. So I'm gonna go to step 2, which is to open an RRSP account. You can open an RRSP account individually, or you can open it at a group level through your employer. So there are some differences. So like if you when you start to work, if you work for a employer that has some not a super small group, you usually have an option to open a group pension account or a group RRSP account. So you can basically set up automatic contributions monthly or biweekly with your payroll, and there will be automatic deduction for the taxes. And the advantage is that it's simple. So like you set up, you don't need to do anything extra. And also usually the management fee is a bit lower than the individual account. However, at the same time, like you also need to manage it by yourself. So like there will be no investment professionals helping you to choose the security. But if you are very comfortable with investing, or if your situation is super simple, you just need to complete the investment questionnaire, usually at the Group Retirement Service website, and then they will start to direct money into the suitable fund moving forward. There's one super important point is that you should try to maximize the amount that your employer can match. No matter if it's an RRSP or it's a defined contribution plan, DCPP, or any group retirement saving plans, that if your employer is matching, you should try to maximize it, because it is literally like free money that the employer is giving to you. And if you don't contribute, you won't get the money. It's still very recommendable for you to open an individual account. So the reason behind is that in the future, if you left the employer, or if you have like more assets you want to invest in, by having an individual account, you will have much more choices for the securities, mutual funds, like different kinds that you can put in. You can also get advice from like a financial advisor or financial planner to choose the funds for you. And you can consolidate your different group accounts in your lifetime into individual accounts, so you can have like one account that you can always use. Okay, there are two specific plans for RRSP that are very interesting for the young professional crowds, or at the early stage of your career. The first one is called home buyers plan. So if you're planning to purchase a home as your principal residence, it's very beneficial for you to set up a goal of try to have 35K in your RRSP when you purchase the property. The reason behind is that the government allows you to withdraw 35,000 from your RRSP account tax-free if you're purchasing a first home. So what's the definition of a first home? It's basically in the 4-year period, you did not occupy a home that you own, or that's one that your current spouse or common law partner owned, which is very important. For example, if your common law partner or your spouse had used his or her use this plan before, then most likely you're not able to use this plan anymore unless you sold the house and like maybe in 4 years you can use that again. So combine, you can also combine this with your spouse. So like together you can together use 70,000 from your respective in total from your RRSP accounts for the home buyers plan for down payment. Once you also, like, you have to be a resident of Canada when you receive funds from the RRSP for this purpose. So like, for example, if you are working or living abroad and you have an RRSP plan in Canada, you cannot use it for this purpose. Lastly, if you get money out of it, you will need to pay back. So there's a 2-year grace period, which means you don't have to do it right away. You can wait for 2 years, but then for the next 15 years, you need to pay back whatever amount that you withdrew from the plan. Another less known plan in RRSP is called Lifelong Learning Plan. This is especially interesting if you plan to go to grad school or further continue education. However, like you do need, this has to be used for full-time training or education. And you can also use this plan for your spouse or common law partner, but you cannot use it for your children. Basically, you can withdraw up to 20,000 from your RRSP tax-free for this purpose, and each calendar year is 10,000. And like the RRSP, you have to pay back, but you basically pay back within 10 years after withdrawing the money. Something extremely important, a lot of my clients, they didn't know before talking to me, is that for both plans, if you wish to use use these two plans, the home buyers plan or lifelong learning plan, the money has to be in the plan in the account for at least 90 days. So you cannot just, oh, I saw a house, I like it, I want to buy it within 30 days, and I'm going to put in 35,000 lump sum into the plan and withdraw it right away. It doesn't work. You have to plan ahead and to leave at least 90 days for you to do it, to be able to be eligible for this. Very quickly, I will talk about tax-free savings account. So tax-free savings account, it is another widely used savings tool, and I think it's very, very useful for the younger crowds as well. So it is like basically whatever amount you put in, if it grows, the interest earned, dividend, capital gains, you won't get any tax bill, even if when you withdraw it. Because for RRSP, like when you withdraw the money, eventually it will be added back to your taxable income. But for TFSA, you can basically regard it as a regular savings account, but without interest income. And also, like during the year, if you make any withdrawals, this withdrawal amount will be added back to your contribution room at the beginning of the next year. If you over contribute, it's very important for both RRSP and TFSA. A lot of like my young clients, they ask me like, how do I know how much contribution room I have? The easiest way, you don't need to calculate the 18% or the how many years you're eligible for TFSA. You just need to open your notice of assessment, and there will be a specific number that the CRA gives you for the contribution room. Any additional contribution above exceeding the contribution room from TFSA and RRSP, you will get a penalty for 1% per month. So just be aware of it. Even though this plan only started in 2009, you do have a significant contribution room for most of the audiences today, I believe. So the cumulative contribution room for TFSA now is 75,500. So if you became eligible since 2009, you basically can save this up to this amount. So it's important for you to have a plan of like contributing to this TFSA, to your TFSA account for whatever financial goals you have. Okay, very quickly, last, I know I'm very conscious of the time, so a lot of people don't know whether I should contribute to RRSP or I should contribute to TFSA. For sure, the answer is it depends. And this is a very high level discussion. So like please do not take advice just based on the slides here. You should, it's specific to your situation. But generally speaking, you should invest in your RRSP if right now you are making like more than 50,000 and you don't expect your income to grow significantly. Because if your income grows significantly in the future, it might make sense for you to wait a little bit and for the future contributions. If you are making over 90K, like it makes sense for you to put it in because you are in a very high tax bracket. Or if you're planning to buy a first home or you're planning to go back to school. And another thing very interesting is that if you become a business owner and like you basically have more tax planning opportunities, then for certain years you can choose to pay yourself less and to withdraw money from your RRSP. So that's also interesting perspective. This is my last slide. So like you should generally invest in TFSA if you're investing toward an objective that's sooner than retirement. So for medium or short-term, medium-term goals, you could use TFSA as an investment vehicle, or like you are investing for retirement and you are making less than 50,000. So it might make sense for you to put in TFSA for now. And in the future, when your income becomes much higher, you can put TFSA money into RRSP and make a lump sum deduction. Yeah, so that's it for my part. So I put my contact information here, and I also put a QR code, which is my LinkedIn. Feel free to add me. And I look forward to continuing this discussion afterwards. So now I'm gonna turn over to Travis.
Thanks, Jeffrey. That was a super interesting presentation. And I'm also terrified now of the time limit because it felt like you got through only a little tiny bit of your subject matter, but we'll see. Can everyone see my screen? Let's see, people could see my screen. Perfect. Okay, so hi everybody. My name is Travis Chalmers. I'm a tax lawyer. I'm licensed in Ontario to practice tax law, so not Quebec. But I'm only going to be talking today about federal taxation. It's pretty simple stuff. We're going to be going over just sort of the basics so that you have a bit of a better grip on how your income is taxed in Canada. That said, I'm not giving any legal advice here. I'm just giving concepts. So because tax rates and brackets change all the time, because the rules change constantly, everything I'm using here is made up for the purposes of drawing a nice clean picture. So that's that. Now, before I get into why we pay tax in Canada, Jeffrey had mentioned earlier the difference between an employee and an employer, and a self-employed person in terms of the taxes that you pay. Jeffrey promised I would talk about this, but it is not in fact in my presentation, so I'll talk about it now. Basically, if you're an employee, you have tax taken off and also your employment insurance and everything else right off your paycheck. If you're self-employed, you pay your tax via installments or at the end of the year. And if you pay installments, the amount you're paying is a guesstimate that the CRA makes based and the Revenue Quebec makes based on your previous year's incomes. So some years you might just end up paying way too much in tax, and some years you might get away scot-free until the end of the year. So questions later. Yeah. So why do we pay tax in Canada anyway? Well, it's not to make politicians richer. It's mainly because we have a system in Canada of redistribution of wealth. So we pay a lot for operation of our government. We also pay tax to give effect to policy objectives. So for example, in Quebec, we have a really generous daycare program. We also have paternity leave and maternity leave. We also have unemployment insurance. We also have incentives given to different businesses. So tax actually is used for all of this stuff, in addition to paying roads, funding the military, funding police, putting fires out. We also have a strong redistribution of wealth concept in Canada. So a lot of the times you will have access to certain scholarships or certain funding that if you're a lower income person that you wouldn't have otherwise. Our tuition is remarkably inexpensive here, and that's largely thanks to the taxes that we pay in Canada. Also, we tax people who earn more money a lot more than we tax people who earn little money. And finally, obviously, sometimes provinces don't earn a lot of cash. Sometimes they produce cash. So we collect taxes to transfer funds between different provinces. So one of the number one myths, probably the main myth, is that if you're taxed at a certain bracket, say 40%, all of your money is taken away at that rate. That is just incorrect. So you're probably paying less tax than you think, and you're probably paying more in payroll deductions than you think. So let's look at how income tax brackets work. So your income is taxed based on what bucket a given dollar of income falls into. So here we have my fake tax bracket of, let me just get my pointer. We have my fake tax bracket here of 15%, and that would be your first tax bracket. I gotta turn off that laser pointer. Okay, laser pointer is a bad idea. So once this bucket is full, you move on and the money starts filling up the next bucket and then the next bucket. And each time you move up buckets, the dollars that go into there are going to be taxed at whatever that rate is. So the first X dollars are going to be taxed at 15%, the next Y dollars at 25%, and the next Z dollars at 38% using these completely fictitious tax brackets. So suppose we have $75,000 of income. So obviously we haven't taxed any of it yet, so we have 75K left to tax. The first bracket, you only get $10,000. So this is really targeted at the lower income end of the population. So once you fill up this bucket for $10,000, your marginal rate here is $1,500 worth of tax at 15%. And so far we've only taxed 10 grand and paid $1,500, and our average tax rate so far is 15%. So far, this matches our concept of being taxed at whatever bracket we're in. The story changes, however, when we move on to the next tax bracket. So let's take this 25% tax bracket and we'll assume that it can hold up to $55,000. So far we have $65,000 left that's not put in a bucket. And then we'll take 55 of that and put it into this middle bucket. So our marginal tax rate is 25% in this bucket for $13,750 more dollars of tax. So far we've fully taxed 65K of income for $15,250 of tax. As you're probably figuring out at this point, only the last bit of it was taxed at 25,000, and our average tax rate is in fact below 25%. It's 23.5. Things get really clear when we add the last $10,000 to our 38% bracket. So let's have a look at that situation. We only have $10,000 of income to put into this 38% bracket because we've already allocated the first 65K. So we put 10 grand in there at 38% is 3,800 more of taxes to pay for a grand total of $19,050. This is clearly less than 38%. In fact, our average tax rate here is only 25.4. So instead of being the 38% that a lot of people feel like they're being taxed at, you're actually taxed at the weighted average of all of the buckets put together. And I have a nice graph coming up soon that explains that more in a different way. So we put $10,000 in this one for 15%. We put $55,000 here, and we put our last 10 here, and the average tax rate ends up being just a little bit above 25%. So when you're thinking about how much tax you pay, you have to bear that in mind. And it's actually a really good idea to look at your income tax return after you file it, because they will typically produce a little report that shows you how much you actually are paying to the tax man versus how much is going to other things such as unemployment insurance or parental insurance or your RRSP if your company is matching it, like Jeffrey had mentioned before. You know, there's all kinds of different things that come off your payroll other than taxes. So here's that graph I mentioned. These were using 2019 Ontario tax rates, okay? And the reason there are so many different tax rates shown here in blue is because we have federal brackets and we have Ontario brackets, and they don't line up. So you end up having this sort of fractured line. But the moral of the story here, income is on the x-axis and your average or actual tax rate is on the y-axis. In orange is your average tax rate, and the blue is the current bracket that you are in. So you can see here for the first bunch of money, you have no tax to pay at all. So that is everybody's free money. So the first, I think it's $15,000 now that you make in a year, you don't pay any tax on. So that's yours. The next bunch of money is taxed at the lowest marginal rate. And you can see right here, your average tax rate takes off, but it starts to curve. And the reason it curves is because your average rate will never, ever, ever be able to reach this 20%. Even if it was 20% across the board, you would never get there because that first little bit of income was taxed at 0. You can never, ever touch 20%. And then we can see the similar thing starts happening as we go up and up in income. So here is interesting, even though the tax rate, the tax bracket here is almost 44%, the average rate at the beginning here is down at 25%. So you're paying 20% less tax than your tax bracket would have you believe. And that sort of trend continues all the way up. I graphed it out to $300,000 of income. So at $300,000 of income in Ontario, the rate was almost 54%, if not, I think it was 54%, but you were paying just over 40% in tax that year, so 15% less. So that's an important thing to remember whenever you're, planning for the future or figuring out what your tax bill is. So where does my paycheck go? I've already mentioned this. It goes to your payroll deductions, it goes to your parental insurance, it goes to all sorts of stuff that is actually not income tax. And you actually get to benefit from it. So if you lose your job or get laid off, such as many people did during COVID, all those payments that you made into unemployment insurance will benefit you greatly. So these are all things that are good things that come off your paycheck, even though you have less cash in your pocket at the end of the day. So filing our tax return, I'm just going to show you here what the due dates are depending on your given situation and who in Canada has to file a tax return. Spoiler alert, everybody has to file a tax return. Okay, so the due dates. If you're employed, your tax return and tax payment due date is April 30th. If you're self-employed, it's a little bit confusing. You have to pay your taxes in full by April 30th. But you only have to file a return by June 15th. So effectively, you have to have your tax return pretty much done by April 30th, and they give you an extra month and a half to tidy it up and make any adjustments that you have to make. And this is important more for self-employed people because sometimes you might not get all your expenses right, or maybe you're waiting for some information. So that's why they give you the extra month and a half. But they do want you to pay by April 30th, or you have interest and maybe penalties. Corporations always file and pay. Well, they don't always pay. They file 6 months after their fiscal year ends. So like a June 30th corporation will file its tax return on December 30th. A December 31st corporation will file its tax return on June 30th. And that's a little, the 30th versus 31st is like a technical nuance. In practice, a lot of people are just filing on the last day of the month instead of the number of the month. Partnerships and trusts always file their returns, or almost always file their returns on March 31st. There's a little exception for trusts and partnerships where all the members are corporations, but that's a big rabbit hole that we don't need to follow. So all residents of Canada pretty much have to file a tax return, except, babies. Deemed resident trusts, so that's a trust that doesn't even live in Canada or reside in Canada, but for some reason is deemed to be a resident here. And any non-residents who are required by the Act to pay tax in Canada, such as foreign landlords, business owners, all those people. This is the key one. Even if you're not a citizen, if you're earning income and you reside in Canada, you have to file a tax return. All right, withholding taxes are a little bit more of a technical thing. they are basically the money that the foreign country keeps if you get money from a foreign company. So this happens a lot if you own shares of like a Google, if Google paid dividends, which it doesn't, but suppose it did. So suppose it did, it pays you a dividend. The US government cannot come and take tax from you because they don't have the legal authority to come into Canada and say, give me the money. So what they do is they tell the US corporation, give me that person's money, and that's what happens. So instead of them taking the money from you, they take it straight from the US corporation. And those are there to allow governments to collect taxes on behalf of the foreign shareholder. So dividends are usually have a withholding tax of 25%. That's a default rate. Depending on the tax treaty, if the shareholder is an individual or if it's a company, it can vary between 5 and 15%. Other types of income that may or may not be subject to withholding tax in a similar manner are interest, royalties, rent, and other types of payments. Investment income taxes. I'm only going to go over a couple of these because of time concerns, but your payment of tax or your inclusion in income for the year on your investments depends in large part on whether you're earning income from like interest, capital gains, if you're earning dividends, partnerships, or if you're getting money from a trust. So all of these I could go through in theory, but I'm not going to. So income is very simple. They just add the number to whatever your income is. So you just put it on the pile. One thing you do need to be careful of is if you're an active trader of something like real estate or marketable securities, shares, that kind of thing, if you're a day trader, or even if you trade Bitcoin regularly, or if you're mining Bitcoin, that can and often is taxable as income, not as capital gain. And if you're not sure what the difference is between those, you're in the right place because we're going to look at that next. All that to say, determining whether something should be taxed as capital or whether it should be taxed as income is a gray area. So if you're not sure, ask your accountant or your tax advisor. Okay, so tax on capital gains is a little bit funny. It's not a different tax rate. Basically what happens is they take half of your income from whatever it is, and they tax you at the normal rate on that. And the other half, they say no tax ever. So that's free money. So for example, if you sell a dividend producing share or a mutual fund asset or a revenue producing property, you'd be taxed as a capital gain. So a capital property is the tree that produces income or the fruit of the tree, if you will. If your business is to sell, I'm going to mix metaphors and make it super confusing. If your business is selling trees, then it's actually the dirt the trees grow in that is your capital property, and the trees themselves produce the income for you. So it doesn't, I know that trees can produce apples, but that doesn't really matter. What matters is what you're using them for. So if your business is to sell apples, then the tree and the dirt the tree grows in are your capital property and the apples produce income. But if you're selling trees, the trees are your income property, they're your inventory. There's a bit of a gray area between the two, which we don't need to get into, but basically it confuses everybody. People go to tax more on this issue, go to court more on this issue than just about everything else. And as I mentioned earlier briefly, the amount that's included from a capital gain, so like when you sell a share, is half of the capital gain that you earn. So if I buy a share for $100, sell it for 200, I'm not including $100 in my income at a different rate. What I'm doing is I'm including $50 in my income and taxing it at the normal rate. And the amount that you include is called the capital gains inclusion rate. Keep your eye on the next budget because our government needs money. I would not be surprised if this got tweaked, maybe up to 66%. We'll see. So right now you're taxed at half the rate. I'll go very quickly over reporting foreign assets. Come on. So if you have any, basically, if you have any major assets overseas, talk to your tax advisor because there's a good chance that you have to report it. If you have a rental property, if you have a vacation property, if you have overseas bank accounts with a lot of money in them, If you have basically anything overseas, you have to report that to your accountant because you may be required to report that on your tax return. You might not, depending on what it is. Like if it's literally just a vacation property, you probably don't have to report it. But if it's a vacation property you rent out sometimes, that has to be reported. So definitely look into that if you are in a situation where you are lucky enough to have overseas assets. If you own a company overseas, there's a whole other set of reporting that you have to do. I'm going to skip all this business because it's quite technical, and I want to get to the questions because you guys are probably going to have awesome questions. Are we at the end yet? Hey, there we go. So thank you, everybody. I'm going to turn it over to our illustrious moderator to finish up with our presentation and then move on to the questions. Hopefully. Okay, so we have a first question here. If I work for an Ontario company but reside in Quebec, would I be taxed in Ontario or in Quebec? This is a good question, and it's a giant pain in the bottom. You are taxed where you live. So Ontario companies that are close to the border are used to dealing with this kind of situation, and they will typically have a payroll provider that just sort of sets you up. However, if you work farther away from the border, or you commute, some people fly to across the country, work there for 5 days, and then fly home for the weekend kind of thing. That's kind of a pain because they may only be set up to do local deductions at source, not your Quebec deductions at source. It's a very good question. Jeffrey, you have this one?
I think this question is more of a tax question. Maybe you can answer that as well. So what advice do you have for Canadians wanting to move abroad to the US in terms of their RRSP and TFSA?
Okay. Yeah, you were probably right. That's probably more of a tax question. Well, the first thing for advice is you are deemed to dispose of everything you own when you move abroad. So, if you have a house or if you have a stock portfolio, you're presumed to sell everything when you move abroad. So forget the RRSP and the TFSA. That is usually the biggest tax issue. Your RRSP and TFSA can remain in Canada. I believe they will retain their status, but you may have to cut off the tax-free growth treatment for the RRSP once you leave. I would have to look into that in a bit more detail, but it's definitely doable, and people do this all the time to still have your RRSP and benefit from it, as well as your TFSA when you move abroad. Another question, another tax question. Do you recommend that everybody have an accountant or tax advisor? No, absolutely not. I recommend that first that you talk to somebody like Jeffrey, who has a good general knowledge of everything. Don't come to someone like me until you have really complicated questions or complicated situations. So I recommend that people with complicated situations, people that are self-employed, have a go-to person. Don't keep them on a payroll or anything, but have a go-to person. But if you're just earning a salary and investing in RRSP, TFSA, don't get an accountant or tax advisor. What you might want to do is just ask Jeffrey for a referral if you have questions that he can't answer, which would be unusual because Jeffrey knows a lot of this stuff.
Thank you. But I do want to add on that. So even for the you ask the audience asks for accountant and tax advisor, even for just regular financial advice, a lot of times you do not need a financial advisor or financial planner to help you as well. If your situation is super simple and that you are just making some automatic savings, there are a lot of good good platform you can do it. For example, like Wealthsimple, like it's doing pretty well right now. Like you can basically use the platform, and also like there are some online brokerage or other or just your group RRSP, group TFSA, you can already achieve a lot of goals there. So you don't have to engage with advisor or planner, but you do need to engage with us, either like you have like a more complicated situation, you need, like Travis said, you need referrals for different situations to guide you to the right direction. Or maybe a lot of my clients, they simply don't have time. For example, they are very good at what they are doing and they don't have time to manage their finances, and it also makes sense to hire another person to manage your investment or other plannings.
Is Wealthsimple any good? Have you looked at it, Jeffrey?
Yeah, I look at it. Like I do think they have a good platform. Like I cannot comment on the investment advice part, but I think just for a platform, user friendly is okay. Now it sounds like we're doing a Wealthsimple commercial here. We are.
That's true. I was just wondering if it's any good. I only ever see their commercials for when I'm playing my terrible video games on my phone. So.
Okay. So the next one, like I can answer, like what are beginning resources, for example, books, website that you recommend for students to learn about, like how to do their taxes, creating a financial plan, learn to make smart investments. So there are a lot of free resources online, and I think for a lot of financial service companies, they have pages and pages and pages of documents for you to learn about the beginning, like the foundational knowledge about all the things you talk about. There is one course that's very interesting. I actually did it myself just to see what they are teaching. McGill actually has a personal finance foundation course. If you don't know about it, you can Google it right now. Just search McGill personal finance, and it's actually taught by Desotel's professors. And they have, I think, 8 or 9 topics regarding to investments and personal finance. So that is completely free. You can start from there, and I think they also recommended some resources there.
Great. Another question is, can I buy a house and rent it, i.e. use the funds for investing purposes? Absolutely. If you're in such a great position that you can afford to buy a house and have it generate positive cash flow, which is much more difficult in Montreal, then yeah, of course, you can use the money for whatever you want to use it for. Another thing you can do is if you have paid off your house, you can remortgage it to get extra capital and take that capital and invest it. And the interest on that mortgage, if you borrowed money to own a house, you cannot deduct that interest. But if you have a paid off house and borrow money out of the house to make an investment, you can deduct that interest. So yeah, there's lots of different tricks you can do. But yeah, buying a house and renting it, if you can get positive cash flow out of that, and that's a little bit tricky in Quebec, but if you can do it, absolutely, you can use the funds for investing.
The next question, Travis, I think you can answer too. So
I think we'll both do this one, eh?
Yeah.
So the question is, do you have resources, books, websites, etc., to learn about?
That's the one
how to do your taxes. So how to do your taxes? It's really not that difficult. I use UFile personally, like for my own personal returns, and it's super easy. I use UFile and like the CRA website. If I have questions about where I'm supposed to put something, the CRA website is really chock-a-block of information once you get used to using it. And the Revenue Quebec's website, believe it or not, is also quite good. Something that bothers me about the two websites that won't ever bother you is that it lacks technical detail for me. So I end up really having to dig, but it's probably the correct level, if not a little bit too detailed for somebody who's just starting out how to doing their taxes. And frankly, if you're just filing your returns for the first time after not living with your parents, just going to UFile and entering all your forms in is a great way to start.
Okay. The next question, I am about to start a startup business, a very new initiative. When should I incorporate my business to ensure any expenses declared under the business? I think, Travis, you're better suited to answer this one.
Yeah, I'll take that one, but can we go back to the previous question? I think the asker also wants to know about how to create a realistic financial plan and make smart investments.
Okay. Okay. The creating. Oh, you mean the resources? So like I already answered that question actually. Like to do it, to like you can there are a lot of free resources online, and you can learn. You can start with McGill personal finance course, but creating a like realistic financial plan, I think. If, for example, you're really starting to get serious about having goals and having different objectives, it's always good to sit down with a professional just to discuss as well. So for example, you can work with the advisor at your bank or at your insurance provider, whatever person that you trust, to talk with the professional to get like at least some guidance on like where to go from now. So and usually, like if you talk to a financial advisor, usually financial advisors are not charged by hour. So if you just do a complimentary consultation, like most of the advisors will be happy to talk to you. But if when your situation gets more complicated and you need to talk to, let's say, a certified financial planner, then maybe the person will be charging by hour. Yeah.
Great. All right, so going over to this question about the startups. I'm about to start a new company. When should I incorporate my business to ensure any expense is declared under that business? I guess if you want all your expenses to be declared under that business, do it as soon as you start earning revenue. Another thing is, as soon as you start having other people involved in the business, you're going to want to set up a corporation, because that way you'll be very, very clear. If you are starting a serious startup, I do suggest that you get legal help from a law firm that specializes in startups. There's a lot of them here in Montreal. They're just everywhere. Even the big firms are doing a lot of startup packages these days. So definitely shop around for setting up a corporation. Some people use them as door crashers, but then they like door crashers, i.e. they're really, really cheap, but then you get what you pay for. Some places are just too expensive. So do shop around for that. And depending on the complexity of your situation and the complexity of your business, and whether you're going to be going for financing rounds and stuff like that, you'll want to have a more or less complicated setup. Another one, how can we claim that money back from the notary? I'm afraid I don't understand this one. Notaries typically only hold money in escrow. So once the title transfers, money should be freed up and directed to the previous mortgage owner or to the previous owner. But I'm not sure I understand that. I'm sorry.
Yeah. So the next question, should someone wait to save enough money to buy a house for eventual rental, or get a loan and buy a house through that? So I can answer this one. So you like, first of all, I for sure don't recommend you to I don't know if you meant that you're pay cash for the whole property. If that's the case, for sure, no. Like, because like if you can borrow money to do it, then like you're leveraging and make money out of other people's money, kind of.
Other people's money.
Yeah, and also like right now the cost of borrowing is very low. Like historically speaking, right now like the interest rate is very low. So for mortgage purpose or for any other borrowing purposes, right now it's not a bad time to do that. And also like even if you want to get a loan and buy a house, like usually you do need to start saving first. Like you can like the bank won't just offer you a mortgage and you pay nothing. Like that doesn't make sense that way. So the way to think about it is to maybe consult with a mortgage specialist or talk to someone that can access your credit score and to see like how much you can borrow, and then you can understand how much down payment is needed, and then set up a financial plan to reach to save enough for the down payment at the time that you wish to buy the property.
This is the notary person again. this is what I thought the question was, but I didn't want to go down this crazy rabbit hole. Basically, what happens is you have a foreign property holder who owns property in Canada, and this happens all the time. They want to sell their property to a Canadian, for example. As I mentioned on the withholding tax part of my presentation very quickly, Canada can't go after you in the United States or in Belgium or whatever for taxes that you owe them. So what they do is they withhold. So the same thing happens when you sell a real property in Canada. The government will require whatever professional is handling the title transfer to withhold a large chunk of money. And if you're in Quebec, it's even larger. So the way you get that discharged is basically the vendor of the property has to file a form saying what their capital gain is, and then they will pay the tax. Otherwise, the notary cannot release that money. So if you're the vendor of the property, make sure you know what your cost is and file that document as soon as you can. If you're the purchaser, put it in the terms and conditions of your purchase that the deal will only go through if they clear everything. It's called getting a clearance certificate. The deal will only go through if they get a clearance certificate from the provincial and federal government, because otherwise, that money may never get out of the notary's trust account. Good question.
Okay. The next one is about investment, so I will take it. So the question is, my parents gifted me a small endowment for post-graduation. What can I do to invest that fund? So it really depends on how much money is there and what do you want to achieve with that. So if there is a significant amount, like relatively to your situation, I would recommend you to sit down with a financial professional just to understand your goals, define your goals, and then to recommend some suitable investments for you. But in general, if, for example, you are not an avid investor and you don't have the knowledge or time to actually self-direct the funds and invest by yourself, the easiest way to do it would be to invest in mutual funds or ETF. But that really you need to do a suitability test, to understand your investment spend, your risk tolerance, and then there could be a recommendation. So sorry, I cannot just answer that directly based on what you told me. But if you want to look at it specifically, you can reach out to me afterwards. The next one: how do we start a self-managed investment portfolio? How do we grow it? Okay, so that's a very general question. So I think there is a difference between speculation and investment. So I feel like a lot of the what the investors who are doing by themselves, especially a lot of young people start to trade and start to buy crypto, to do things that are hyped. A lot of the behaviors are speculation. I don't think it is for investing for a long term. So if you said it's a self-managed investment portfolio, so I think that you understand the importance of diversification. It's important to put your money not in the same basket, and to actually divide your money by geography, by industry, to basically the asset allocation process is extremely important. And if you don't feel sure about it, always talk to an investment professional, financial advisor about that.
So it looks like we're out of time here. Jeffrey and I could go on this stuff for literally days at a time. So if any of you want to chit chat, feel free to hit us up. Catherine, you want to come back on the screen and close out the webinar?
Yes, thank you so much. So yeah, I'd like to thank everyone for joining us and hope you are leaving with some valuable insights to help you navigate any of your financial decisions. Also, special thank you to our presenters, Jeffrey and Travis, for being here. You can always connect with them on LinkedIn and keep the conversation going if you need to. And as we mentioned, this is our the first event of our financial literacy series. The next event will be focusing primarily on credit, and it will take place in April, so stay tuned for that. And stay connected with the McGill Young Alumni. We are planning several exciting events throughout the year, and the information can be found on our social media. So be sure to follow us on LinkedIn, Instagram, Facebook, and Twitter to get all of the details. And in the meantime, feel free to catch our next event. It will be a comedy special taking place on March 10th at 7 p.m. Eastern Standard Time in support of McGill 24, the university's one-day online fundraising initiative to support students, researchers, and student athletes at McGill. You can get more details at alumni.mcgill.ca/events/McGill24. Lastly, a follow-up email with today's recording will be shared with you, and tell us in the survey what topics you'd like to hear about from us. Have a great evening and stay safe, everyone.